I need to sell everything.
No, you don't need to sell everything. Because what you just watched is the most common myth that plagues investors. The news right now is depressing to look at. Yes, I agree. Your portfolio right now is probably depressing to look at too. But sell everything? That's not an investment strategy. That's actually a symptom. A symptom of one of the dumbest investment myths we've seen. Quick, shallow visits don't build anything lasting in the world of finance. But you know something that has lasted the ages? The story of Sisyphus. Just as Sisyphus was punished to push the same boulder up the hill repeatedly, investors often face similar patterns. When markets start to fall, the same questionable investment takes seem to reappear. Like clockwork, these bad deals surface during every downturn, tempting worried investors who hope to avoid losses but often end up worse off. Bear markets are scary. There's no denying that. When your investments are plummeting, it's natural to feel panic. But making investment decisions based on fear is like driving with your eyes closed. Dangerous and likely to end in disaster. It's enough to make anyone want to hit the eject button. But here's the thing, those panic-selling urges, they're not wisdom. They're symptoms of buying into investment myths that show up every single time markets get rough. Today, we're calling out these myths for what they are. They're damn dumb. So let's dive into the biggest offenders. Myth 1. Sell everything. The most common response to market downturns is the panic sell. Things are bad, it's all ending, sell everything. This knee-jerk reaction stems from a condition where investors suddenly believe they can predict global economic trends based on headlines and news snippets. These macro tourists see terrifying connections everywhere. Trump will cause the next Great Depression, the pandemic will kill us all, Russia-induced World War III will kill us all, China's collapse will trigger a global meltdown. Here's the problem. If you're panicking now, you've already messed up your entry. And if you sell everything, you need to get two things exactly right. Your exit and your re-entry. The odds of getting both correct? Well, let's just say that if you were great at market timing, you'd be on a yacht right now, not watching this video. We detailed how timing the market just doesn't work in our last video. Check that out if you want to know exactly why it doesn't work. But regardless, even if you're convinced that catastrophe is coming, sell everything isn't a strategy. Money doesn't vanish from markets, it moves. A better way to spend your time would be in identifying where that money is going instead. Myth 2. It's too risky to invest right now. I'll invest when things calm down. Well, then I'm afraid you'll never be investing. Because the world is always risky. That's why there's an equity risk premium. No risk, no premium. Look at these uncertainty indices. Notice something? There's always uncertainty. Markets digest bad news and move on. Just in the last 7 years, you can see how many risky incidents have unfolded, and yet none of them directly resulted in an immediate market crash. Some might have even preceded upturns in the market. If you're waiting for perfect conditions before investing, you'll be waiting forever. The better approach is to understand that geopolitical risks affect markets through multiple channels. They can reduce investment, employment, trade, and economic growth temporarily. I say temporarily because as time goes on, companies tend to figure out a way to adapt, business continues, and markets recover. But risk will always be there. Like we said in our previous video, risk is a feature of the market, not a bug. The reason equities beat risk-free assets over the long term is precisely because they're volatile and scary to hold. And waiting for risk to disappear before investing is like waiting for water to not be wet before taking a shower. Myth 3. The economy is bad, so stocks must fall. This sounds logical. Bad economy equals bad stocks, right? Wrong. The data shows zero relationship between economic growth and stock market returns. In fact, it's even weirder. Countries with lower growth often have higher returns. Mind blown yet? Here's why. Countries with high growth attract tons of investment, driving up prices, leaving less room for future returns. Markets are already factoring in what they think will happen to the economy next year. Economic growth can sometimes benefit workers instead of shareholders. Now, add that to the fact that economic data points are subject to revisions, changes, adjustments, and get updated on a periodic basis for a long time after the initial results come out. It becomes a fool's game to try and use the economy as a way to forecast your investments. Remember the last global financial crisis? It was 2008, right? Well, actually, that started in December of 2007 and wasn't discovered and verified by the US National Bureau of Economic Research until December 2008, which was a year later. And by that time, the recession was just ending. The recession of March 2001 wasn't officially called until November 2001, and that's just about when it ended. All of which should firmly tell you that the stock market and economy are not that related at all. Myth 4. It's all because of politics. So if the economy doesn't affect things, then it must be politics. Look, I get it. Politics is emotional. But mixing politics with investing is like mixing tequila with decision making. Nothing good comes from it. Zoom out for a second. India's stock market has delivered around 15% annual returns over 45 years through 11 different prime ministers and 4 different political parties. Do you really think one politician has the power to completely reverse 4 decades of economic momentum? That's giving them way too much credit. Politics can cause short-term market noise, but rarely changes long-term trajectories. It's not that policies don't matter at all, but policies usually take time to implement. They play out on the scale of years. To base financial decisions on short-term political noise is investing suicide. So keep your politics out of your portfolio. Myth 5. What if we become the next Japan? Yes, the ultimate fear. What if our market takes 35 years to recover, just like Japan's did? This is like refusing to drive because you might crash, refusing to eat because you might choke, or refusing to date because you might get dumped. Context matters here. Japan's 1980s bubble saw absolutely bonkers valuations, far higher than anything we're seeing here today. High valuations in the present pull returns from the future. That's about as close to an ironclad law we have in finance, and that's why it took Japan 3 decades to reset. Why are these myths so stupid? So why do smart people fall for these myths? Well, that's because money isn't just numbers. It's dreams, hopes, and fears all rolled into one. And when markets drop, it feels like your future is crumbling. This triggers the part of your brain that's great for running from tigers, but terrible for investing decisions. You see, investing is simultaneously simpler than we give it credit for, but harder than most anticipate it to be. I know, it's weird. And what doesn't help is that as humans, we're hardwired to pay more attention to scary news than we should, seek information that confirms things that we already believe, and we tend to think current events are special and unprecedented. Add social media and 24/7 news to the mix, and you've got a perfect recipe for panic-driven decisions. So what should you actually do instead of falling for these myths? Never go all in or all out. Extremes are for teenagers and dictators, not for smart investors. Rebalance instead of panicking. If you think markets are overheated, trim some equity and add some debt. Don't blow up your whole portfolio. Know your game. Are you investing for 20 years or trading for 20 minutes? They require completely different approaches. Ignore the loudest voices. The correlation between confidence and knowledge in the finance industry is usually negative. When you feel the urge to panic sell, wait. Sleep on it. The market will still be there tomorrow. Your sudden urge to sell might not. Study financial history. You'll realize there's nothing new under the sun. Just the same patterns repeating with different characters. Look, I get it. Seeing your portfolio in the red hurts. It's personal. It's emotional. But the investors who build real wealth aren't the ones who predict every market move. They're the ones who stay in the game through the ups and downs. Market crashes aren't new. Neither is the panic they cause. What separates successful investors from the rest is how they respond to that panic. So the next time everything looks like it's falling apart and that voice in your head screams, "Sell everything," remember this video. Take a deep breath and maybe just don't. Your future self will thank you. If you found this helpful, smash that like button and let me know in the comments what other financial myths you'd like me to tackle next.